Equities fought volatility and surged last week as stocks danced to the tunes of global cues, domestic news flow, and corporate earnings. Among indices, financials led from the front, while a steep cut in excise duty on fuel prices and capping of sugar exports saw stocks from these sectors react negatively. Eventually, the BSE Sensex moved in a band of 1,500 points and finally ended the week with 1% gain. The NSE Nifty 50, on the other hand, was up 0.5%, while the Bank Nifty surged nearly 4%. However, despite last week's gains, the benchmark indices may end the current month on a negative note, marking their biggest declines in May since 2012. The BSE benchmark Sensex and the Nifty were down close to 4% so far this month, primarily dragged down by the persistent FII selling. Foreign investors have now been net sellers for 8 straight months and have net sold stocks worth more than 52,000 crore rupees so far this month. According to VK Vijaykumar of Geojit Financial Services, FPI selling is showing mild signs of exhaustion. DII and retail buying, together with overwhelming FPI selling along with short covering, can trigger a near-term rally. High-quality large caps can stage a rally, says Vijay Kumar, adding that leading banks are safe bets. Against this backdrop, Business Standard's Avdut Bakar shares how banking stocks are placed on the charts.
The Nifty Bank Index has formed a double bottom, and even one could say there is a formation of inverse head and shoulder on the daily chart, which symbolizes an underneath positive strength. From here onwards, the momentum looks very strong, and as long as Nifty Bank holds 32,700 from a medium-term perspective, one could see a sharp rebound in Nifty Bank. The next hurdle for this index comes to 36,000 and 36,700, which is approximately 3.5% higher from the current price. In terms of its constituents, the banks in the Nifty Bank Index, one could be very positive on AU Bank, Bandhan Bank, and Bank of Baroda. One of the reasons for these three banks is they have successfully managed to afloat to stay above 200 days moving average during the recent correction, and investor community considers 200 DMA as the most relevant indicator while taking their investment decisions.
Markets will look at Q1 CY22 GDP number slated to be announced on Tuesday for fresh cues on the economic recovery. As per a Reuters poll of economists, India's economic recovery from the COVID-19 pandemic likely stumbled again in the first quarter of this year, primarily due to Omicron-related restrictions and higher inflation. Growth in Asia's third largest economy was penciled in at 4% for the January to March quarter from the same period a year ago, down from 5.4% in Q4 2021. If realized, that would be the slowest in a year and a third consecutive quarter of weaker growth. Amid these triggers, technical charts suggest that the NSE Nifty managed to close above its 20-day moving average for the first time since April 13, 2022. The Nifty may look to target the trendline resistance around 16,750 in the near term. On the downside, the index can expect support around 16,200 level. As we draw curtains on the Q4 earnings season, stocks like Aurobindo Pharma, Delivery, IRCTC, Jindal Steel, and Sun Pharma could see some action ahead of earnings on Monday.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.